wanted to talk a little bit about the equipment one because so much of our audience is involved in some way. Probably 95%
Mhm.
has
Equipment,
equipment
yeah.
that is financed. What are some of the ins and outs of financing? You know, like you said, trucks or heavy equipment or manufacturing equipment, things like upgrading to new equipment, things like that.
Yeah, so I mean, there's traditionally there's four ways to finance equipment,
Mm.
right? You know, one way is just with your own cash from the business, right? People don't think of that as financing, but if you're using your own cash, you know, there's opportunity cost of you being able to use that elsewhere on different projects and whatnot. So financing it through your own cash. Secondly, is through an operating lease. So an operating lease is where, you know, say it's Hitachi owns the equipment and they lease it to you on a monthly basis for, you know, a set period of time. It might be a short-term lease where you're just renting, you know, a Bobcat for 6 weeks for a project, or it might be for 5 years or 3 months or 6 years. So it's the operating lease at the time the lease expires. You know, there might be an option to renew or what have you, but
Mhm.
the equipment goes back to Hitachi and Hitachi owns it and it's off your balance sheet. And basically, as a business, you write that off as a lease every month, right?
So as
So
opposed to being an depreciating asset, it's
it's
actually
just a lease expense, right?
yeah,
Similar to like if you buy a building, you either, or if you're looking at space in a building, you rent the building, which is just rent coming off, whether it's lease or rent, however it shows up on your income statement. It's similar to equipment, right? So it's just a lease. The end of it,
hmm
assets owned by the vendor or whatnot, and you move on to the next project or the next piece of equipment. So that's an operating lease.
yeah.
Then there's a capital lease. So a capital lease is a unique way of effectively buying a piece of equipment. So again, you might go to a Hitachi or Caterpillar or whomever and buy the piece of equipment, and you're sitting down with them and they offer you, whether it's themselves through their financing programs or through a bank, a capital lease. So a capital lease is very, I would call it almost more similar to a loan, but it does have characteristics of an operating lease from a tax perspective, and I'm not going to jump into that. I'm not an accountant. You know, talk to your accountant about it, whether, you know, what option is the best, but
We got to find an interesting accountant to come on.
We
yeah,
should
right?
have an accountant and Brad.
Yeah, there you go. Accountants actually are they're a lot. They can be a lot of fun outside of the office, right? They still know how to have fun and, you know, drink beers. And, you know, have a
Actually,
good
when we
time.
sit down with the accountants, I always really enjoy it
Yeah,
because it's all stuff that I'm trying to like.
they're very knowledgeable, right?
Depends
The
on
one-
your interest. Most people, it's
Yeah.
like, but if I was doing it every day, then I
Exactly.
wouldn't do it.
So yeah, so a capital lease works more like a loan. So
Mm.
it'll traditionally be, okay, the asset is $100,000, say, and you're going to sit down with the lender and okay, we're going to do a capital lease. You basically pay a principal and interest portion for a 5-year term, say, of the loan, and at the end of it, you have a small amount. It's, you know, that amount is negotiable. It can be $1, it can be $100, or it can be 10% of the asset or 20% of the asset. It's kind of negotiable in the stage, but at the end, you have an amount that you pay the financer, and then you own the equipment.
Mm.
And it's more like a loan, a traditional loan that people think of. The capital lease has certain tax benefits to doing it. It allows you to be a little more flexible with how you're writing off the asset, how you're depreciating the asset.
Right.
So, you know, that's a good conversation to have with your accountant. Hey, we're looking to buy a piece of equipment. Should we do an operating line or an operating lease? Should we do a capital lease or a loan? The third thing the last one I'll talk to you about. So that's a capital lease. So you might have it for 5 years, and at the end you do $100 payment, and then you own the asset. Technically, during that period, the vendor still owns the asset.
Okay.
So you're still leasing it.
So you're in effect leasing for holding future assets.
Exactly right. So you're leasing it. It's like a lease to own.
Yeah.
Kind of. I guess you can think of it like that way. So yeah, that's a capital lease. The banks like it because from a realization scenario, they own the asset already, right? They don't have to go register and discharge yours and take ownership. They already own the asset.
Right.
They just have to find it and get it back,
Right.
if it's out on a site somewhere.
Yeah.
So yeah, that's a capital lease. And then there's a loan. So traditionally, there's a loan. You know, you walk into a bank. Most people are familiar with a loan, and you know, you own the asset. It goes on your balance sheet. You have a loan, principal and interest payment.
Mm-hmm.
At the end of the loan, it's paid out, right? There's certain characteristics of each that, depending on the business's situation, it'll help us. You know, we'll help guide them. You know, with their account traditionally on what might be the best option, because they all have different features that are attractive and some features that might not be. So for instance, traditionally a capital lease, they'll do higher leverage, again, because they own the asset.
Right.
There's actually tax benefits to the bank as well for how that's structured. So traditionally they'll do higher leverage on newer equipment for under a capital lease. A lot of them are doing 100% financing for it for the right businesses that are cash flowing. But most of the times, capital leases, you're locked in. If you you finish a project 2 years into a 5-year lease and you're sitting on some cash and you're deciding, for your balance sheet and for the business, we want to pay down this capital lease. A lot of them have restrictions where you can't. You have to just pay it out, right? Same as, if you lease a building, traditionally you want to leave 2 years in, you pay the rest of the payments, right?
Right.
So, those are things to be definitely consider. And then whereas a loan, most loans can be paid out at any time.
Right.
If you lock in with a bank on a 5-year fixed rate loan, that's different. But if you're working on a variable loan, an open demand loan against a piece of equipment, traditionally the banks will let you pay it out. There's no penalties to pay it out, and it's kind of as your cash flow permits. The other thing that's maybe unique and attractive about a capital lease is that it's real easy to identify that one piece of asset and for a lender to secure specifically against that piece of asset because they own it themselves, right? So they can carve it out from the business's other security package that they might have with a bank. If the bank has an operating line and some other mortgages and stuff, the bank will take a general security agreement, a GSA over the whole business. It's easy to carve out one piece of equipment under a capital lease somewhere else.
Right. So the bank, if they were doing that, like an actual loan for that, they're not going to fund 100% of you buying that equipment, right?
Traditionally, under the loan format, it's 65, 75, but certainly it's doable at 100. The really unique thing in commercial that I love, in residential, there's rules that are set by the government. The bank's got to follow them, right? They are strict. They're rules. Banks have policy guidelines, not policy rules, policy guidelines, right? On the commercial side, so. They don't like making exceptions to the rules, to the guidelines, but for the right business with the right cash flow, if they look at this and say this, we're going to get our money back, they might do 100%, right? We've seen guys do 110%, 125%, and certainly there's different lenders along that, the risk threshold that will do more and less, and obviously everyone needs to understand, in residential lending, traditionally, if you can get approved, the posted best rate is what you get. It's out there. You see it. Everybody knows.
Yeah.
I'm not up to speed on what rates are today. 3.95 or whatever it is. You get it. In commercial, it's all risk based. So if you have a very simple transaction, you're likely and you have good cash flow, you're going to get the best rate compared to anyone else, whether it's across your industry or whatnot. If you're in a really safe recurring revenue government contract type industry, that's safer for the banks. You get a better rate than somebody that's in a riskier project-based, eat what you kill type industry, right?
Yeah.
So commercial, it's all priced based on risk. So we have the ability to structure things differently, which might increase the risk for the bank, which might increase, obviously, the rate. But as a business owner, you make that decision. Is it worth getting more leverage to pay a little bit higher rate because we can invest it in the business and whatnot, right?
Yeah.
But yeah, so that's kind of the spread of how to finance equipment. The equipment marketplace is saturated. There's a ton of lenders out there, right?
Yeah.
One of the things that we see a lot in the industry is businesses that a project or something comes up and they need the equipment now, right? So they just go to the lender that they find the quickest, and generally the lenders that can do it the quickest, it's because they ask the least amount of questions. They're more comfortable just securing on the asset, so they're going to be a higher rate, right?
Right.
So you ultimately pay for it. If a business, especially a really good business, has the ability to have the foresight that we might need this type of equipment, or, again, that budget that I talked about, we've got our budget for next year. We've got these 3 or 4 contracts coming up. These are types of equipment. These are the capital expenditures we might need to make. If they come to us ahead of time and then we go to a primary lender, we can often get a lot of that pre-approved. So we can get an equipment purchasing line pre-approved that says, over the next 12 months, here's $8 million that you have available that's pre-approved, subject to you producing invoicing and at the time being within your covenants to just go do it. So that process to get that line initially takes some time, and it's a pretty overwhelming process that we'd be happy to help anyone out with. But at the time of funding, the project might come and you might need the money or a machine breaks down, you need a new one quick, they can fund really quick.
Just so long as you can provide paperwork that you are going to in fact purchase this
yeah,
equipment. Essentially.
and a lot of the times they'll fund it directly to the vendor.